Hello everyone, welcome to day 185 of my High School Beauty Journal. And today I will be talking a bit more about economics, and today I'll be talking about financial markets. So there's a few things. There's one thing called stock markets and one thing called bonds. These are two main kinds of, financial markets where big companies can get money or get loan money basically from public people. One is bonds. Now bonds is super easy. You put out a bond and you give it to any person who wants to buy it, and they give you money in return. And I'm talking in the perspective of a big business. Now this big business, basically what they're trying to do is maximize their money. Let's say Walmart trying to make the next big store in, I don't know, maybe Atlanta, Georgia, because their already current one is kind of small. Very simple. So they get a bond, get the money, and they'll have to pay the money that they got from the bond plus some interest. Now, of course, the market can switch, and sometimes the interest can be varying. Normally, the interest vary with, I'd say, if your company is very untrustworthy, like let's say your company is a small one, just started, the interest rates are going to be very high, which would actually give assurance to the investors that, oh yeah, if we put money into this company with using the bond, even though they might not pay us back, there's a high chance that we'll get a lot more money than if we invest maybe into the government. Why? Because the government will have low interest rates because, they trust them. The next thing is the stock market. Now, kind of everyone knows about the stock market, but exactly what it is, kind of easy to explain again. They basically issue stocks of the company. Like let's say the new Snickers company or just any company issues 10 million stocks. Now, if you buy one of those, whatever the price is set, you will own 1 out of 10 millionth of that company. Now, what this does is that you own a bit of that company and you pay money to, well, the guy. And in return, if you ever are willing to sell your stock, basically going back into the stock market and someone else buying it, so kind of trading, you get money in return with interest. Now, of course, this money can go down if, let's say, the company goes bankrupt, but most of the times, it's that type of investing loop. But that's going to be it for today. See you guys tomorrow.